Welcome, everyone. I'm going to start with the very first slide, obviously, as one does. That's a pretty obvious statement, Rory. But if you look at it, the good news is it's the last comment we made on a blog post on annual planning last year. And the summary is, I felt really good when I read that now, which is the world can change on a dime, and when it changes on a dime, we'll change too. And everything we said about growth will be out the window, and we'll be totally switching on cash. And I don't know if it's going to happen in 22, but it will happen, and when it does, you got to be ready. And the good news, it's pretty much happened. I mean, it's pretty clear. I feel good about that. It was predictable, but it's happened, and it's happened in 2022. And let me tell you two things I'm not going to do tonight, and one thing I am. I'm not going to try and do forecasting. I think macro forecasting is a fool's errand. There's a John Kenneth Galbraith quote that I've heard that I just love. He said, macro forecasting exists to make astrologers look good. The second thing I'm not going to do is tell you guys how to do budgeting. You all know how to do budgeting internally far better than me. I don't have a real sense of that process. That's not what this is about. I think what I do have a decent sense of is how my world thinks about budgeting and how venture people are approaching budget. So think of this not as this is how you should budget, much more as this is a real-time snap on how venture people are thinking about all this stuff today, and it might be helpful for you as you think about addressing your VCs. The venture board member dilemma. This is first place. This is something really obvious, but this is kind of on the left-hand side. This is growing into the valuation, right? If you ludicrously overpay for a company, and you get enough growth rate, you can earn your way out. And it's obvious when you say it, but it's just great to look at the math. I mean, you see, public companies were trading at 16x. Now they were down to 6.2x. That's the average SaaS company growing at 30%, right? But if that company can grow at 60%, in 2 years, you've earned your money back. The math gets harder if you're a high-growth public company, SaaS, trading at 81x. You got to grow at 105%. And even some idiot who paid 100x run rate revenue for a privately venture-backed company, and they're now trading at 20x. Just 2 years of 123% growth can get you back to flat, right? Now, that's no way to live your life, 2 years of flat, right? But it's that logic that allowed everyone to lean in. And basically, growth is the only way that's going to save all the VCs who've overpaid. So we should be leaning into growth. But then the really odd thing happens is this. Growth costs money, right? And money raises the risk of a down round. So the same people who most need growth are the most terrified of a down round, because a down round means you were wrong and you look like an idiot. Nothing happening means you can't prove I was wrong, but a down round proves you wrong. So you've got this really weird dynamic with your venture board member, right? And then on top of that, sometimes they're saying slow down because they're worried about a down round, and that's kind of dubious, as I say. But other times they're saying slow down because they're right and the market isn't there. When you're getting feedback from us, the little model in your head is this someone trying to optimize their book to avoid their embarrassment, or is this someone trying to help me figure out what's really going on in the market? And both can end up with the same advice, but trying to distill that is really a hard part of what the CFO is doing. Because if that's the venture dilemma, the CFO dilemma is on the next page. What you know is what happened to valuations. That's a fact. What you don't know is what's going to happen to the real economy, because not a lot's been obvious there yet. What you don't want to run out of money and look like an idiot. That's job one of the CFO, because you do get blamed when you run out of money. That's just the rules, right? But what you do want to do also is preserve the upside in the deal. The point is not just to spend 4 years of your life trying to earn to get our money back. You're in it to make upside too, right? And it's balancing those things that makes, I think, your job in this budgeting cycle very hard. It really is a CFO dilemma. What we know in valuations is pretty obvious. The mass dilution is over. For 2 years, everyone believed these things were worth 80 times run rate revenue. They're not. They're worth 6.2 times, just like the last 20 years. If you'd gone to sleep in March of 2000, you wouldn't even know anything happened, but we didn't. And decisions were made, and costs were incurred, and valuations were paid in the last 2 years that now just don't stand up to the light of day. So that's what we know about valuation. What do we know about the real world? What's going on in the actual economy, right? When does the recession shoe drop? And for the first 2 quarters, it's been kind of unclear, and that's why we've avoided pontificating. It could happen, but we haven't been, I won't say certain. It's hard to know what's really going to happen, right? I will say, what we started to see in Q3 is something different. We definitely saw a slowdown in Q3. I mean, we shared with you the numbers. Your growth rates are down. Plan achievement is way down. Q3 was a very tough quarter. And again, I always try and distinguish what we know to be a fact from what we think might be a future. All I can tell you is Q3 was a darn sight tougher than Q1 and Q2. Lots of companies struggle to make plans, but an important point here is there's still a wide variance, right? We have this other chart I didn't include that shows, there's been a wide variance in terms of public company guidance between companies still doing well, companies down a little, and companies just really struggling. So the average story doesn't fully tell it all, and you've just got to be very fact-driven on your particular circumstance. if you look at the overall trend rate, the ARR growth rate, you can see it's now, our portfolio, which I tend to find tracks everyone else's, we're all in this together, right? Is that, growth rate has definitely slid down and is now, a little bit lower than pre-COVID levels, right? We asked you guys to forecast whisper numbers last year, which was, hey, it's November, what's your first pass sense of what's going to happen in the next year? And, you did pretty well. And in fact, there were surprises to the upside. I mean, you can see it. The average company was down. Everyone thinks they'll be great. Some people turn out to be even more great, but on average, you do a little worse. So when you look at these forecasts, and I kind of put this in to calibrate as we're going to talk about next year, right? That's what happened in a less uncertain, not less uncertain environment. That's what happened when the first half was less uncertain, and then it kind of slipped away. So we also asked you guys for estimates for 2023, right? And we've got your estimates here, we share with them, and you can see it's not a long way down from 2022, for the high growers, and even on average a little bit above. And my first response to those is, it feels a little high, right? And I tend to be an optimist. I tend to, believe more than, you want to lean in because we're in the growth business, right? But I just look at these and I go, we'll see, right? And if you look at the next page, the public comps, interestingly, are telling roughly the same story, right? Fact I did not know until I had Eddie look at it is that the 2022 growth rate for public SaaS companies is going to end up 2.5 points above the January forecast. Would not have guessed that, right? By the way, that's not true for internet stocks. They hit it hard. Growth evaporated for advertising, obviously for crypto. But for SaaS as a whole, which is where most of you guys play, we're actually up a little bit on start of the year forecasts. If you look at 23, on the other hand, you've kind of got the shoe starting to drop in that the forecasts that they made at the start of 22 are now being guided down. So you're kind of 3.5% down. So you're clearly starting to see people go, Again, you update your Bayesian prior and it says, there might well be a downturn here. And that's all you know at this stage. I always refer to James McIntosh in the Wall Street Journal, whom I, by the way, think is one of the best writers in the Wall Street Journal on macro, and normally most of them aren't. It's a really good piece. He's basically, the valuation shoe has dropped. Are we ready for the recession shoe? I actually have him on alert. He's one of the few writers there that's like, I like to read his piece every time. And he's basically saying, what we know now is that valuations have reset provided growth stays solid. Will growth stay solid? And then the next page is, we're still nothing like the great financial crisis. This shows SaaS growth rate and GFC, right? It's from James Baldwin at, I think it's at Altimeter now, right? We went from 40% growth to a low of 10. So when I look at all this data, what I say is, at a high level, again, avoiding forecast, all you know for sure, all that seems reasonable at this stage is, 23 is clearly going to be tougher. It's going to be down. It's not yet clear it's anything like the GFC, so you have to be planning for a, dare I say it, normal kind of recession and not the end of the world. That seems like the sensible bet. I mean, you probably also got to run the tape on a plan B for what the end of the world would look like. But it would, back to that comment on not foreclosing your upside, if you can avoid it, I wouldn't recommend planning for the end of the world as a base case, because the decisions you make will foreclose your upside. That seems to be unnecessarily overly conservative at this stage. Which is not to say it's a Pollyanna, which is not to say 2023 won't be easy, but a 30% growth SaaS index going to 20% is very different than a 30% growth going to sub 10, right? So that's kind of all you can say at this stage. And then within that, I think one of the key things we believe is it's just never a one-size-fits-all world, right? For example, we just had this morning a company in our portfolio that we invested in 5 or 6 years ago at $1 million. It's now doing $100 million. They closed around at $1.7 billion this morning, right? Great valuation, great new investors. People are doing deals, right? It's hard. It's a lot harder than it was. And this is a construct that we've blogged about, right? And some of it is pinched from other people in terms of ideas. It's just, can you distill where you are into just two basic questions? Are you growing fast, and are you efficiently growing fast? And a few minutes thought makes you realize that absolute burn dollars doesn't really convey that, because the faster you grow, the more you burn, even if you're efficient. But what we've built is this 2x2, where one level is kind of benchmark growth rate relative to your size, and the other is benchmark burn multiple, as nicely defined by David Sachs in that piece, relative to your size. And we can put the dots in the space, and it just gives you, it's not like it's gospel, it's not laid down from on high. We always tell people, there's always nuances, but it's kind of a rough sizing of where you are and over time. And on the next page, this is what we try and share with you every quarter, which is just, we call it the dot chart, right? You know, where you were in 21, where you were in 22, you know, how you're moving across the quarters, right? And what you see here is, you know, this is just an example one. It's not, you know, any particular company. But, you know, Eddie, who's here, if you there's a hand, Eddie, has joined us in the last year. And we're really trying to do a better job at getting this information out to you. And if it's not, you know, if it's not correct, let us know and we'll tweak it, right? Because the funny thing is, even though this is a rough heuristic, right, and there's all sorts of nuances, our observation internally is about 90% of the time when we're doing a portfolio review, you can just look at the dot chart for 3 years and it tells a story. It's just amazing. It's just like, yeah, and the reason we like it is because you get all the detailed noise of this is the exceptions and this is why it's different. Zoom out. We're not going fast enough, or we're going fast enough, or spending a lot of money. It just allows you to orient yourself very clearly and very quickly. And, you know, and that's kind of, it's really helpful to start, because going back to that CFO dilemma and in the context of, before you can decide where you're going, you got to have a sense of where you rank in the scheme of things. You know, are you awesome and can raise money tomorrow? Are you on a track where maybe you can raise money in a year? Or do you have no chance in hell? Those are very different plans. Kind of diving down just quickly on the budgeting process. You know, as I think about what do you know, normally I spend a lot of time on kind of forecasting revenue. I think the variance, I mean, I think it's always hard to forecast revenue because obviously costs are manageable if you're a competent CFO, and we like to think you all are. Whereas revenue, you know, it's outside your control. When I think about 2023, the obvious point is, you know, how do you take into account Q3 for your forecast for 2023, and then just the churn explosion. I think one part of the recession was predictable long before Q3, which was the impact of valuation collapse on tech demand for tech companies, right? Which is, if your customers are other tech companies, you know, when Facebook's laying, it was pretty obvious from the start of the year that if your SaaS business was about selling SaaS software to other SaaS companies and to public, you know, internet companies, you were just going to have a compressed year or two because of the layoffs. And that's kind of already starting to happen. I think the real question is, you know, how does churn ripple out into the wider economy? You know, what's a reasonable set of assumptions? Because remember, the rest of corporate America is doing pretty okay. Unemployment is 3.6, 3.7%. It's all not ending yet. What would a churn spike look like? Second, obviously, big point is the cost structure. I was trying to kind of, again, this is where I was trying to distill what's the big aha for me, right? And the big aha for me is just kind of your cost structure is almost certainly wrong. It's just that simple. Of course it's wrong, because we made decisions based on la la land, right? People, like engineers thought they got $1 million, and maybe you didn't give them $1 million, but you gave them 300 instead of 200 to get them in the door, right? Your cost structure is wrong. You should just assume it's wrong. And you know, that applies to real estate. You know, you have the whole COVID in, COVID out story, right? And I think you should internalize, and this is a key point, the only choice you have is, you know, a sharp fix because you got no choice, or a gradual fix, grinding it out over the next year or two, right? And I think that latter one can preserve the upside, but but the two challenges with that are, first you have to have the intentfulness and the support to do it, right? And then secondly, you have to get the board support, by that I mean from the team, and then secondly, you have to get board support, you know, because you're having this dynamic of, you know, sometimes, you know, should we just all cut now, or should we do it over time? And it's obviously easy to say cut now, but I think sometimes structurally fixing things is better than just lashing out, right? As perhaps we're seeing today. Sometimes, you know, doing things in a hurry can make things harder, not easier, right? And but I think to earn the right to do that, you've got to come in with the mindset that says, I know it, I get it, we're going to change this cost structure, and I'll talk on the next page about some ideas. And then obviously on cash, I think to any extent when you're talking about, you know, money and running out of money, you got to frame everything not just in terms of money. Because if you present me a choice of, would you like to spend 20 million or 10 million? I'm going to vote for 10. Everyone's going to vote for 10, right? And especially if the ARR this year is the same, you got to present it in everything's got to be presented in the context of the corporate objective. Otherwise, you'll just get lost in finance land, right? The next page is some short notes, and I'm not going to go through them detail, but actually it's from a CFO in our portfolio, Dylan Smith, a young CFO at the time, Box, public company. We had an activist, and I think the summary is we were a high-growth company, you know, with all the glorious stuff that you guys have been going through back in, you know, 3 or 4 years ago, that had to transition into getting profitable, was pushed by activists to do it, you know, like overnight by getting rid of gazillion people, and instead signed up for making it happen over 2 years while preserving the upside. right? And they just did it, and they made a long list of things to be done. They had a subcommittee of the board that met every month to go through it with them, and they just ground it out. And all credit to them. That's why they're an independent public company today, not acquired, and that's why the stock is massively outperformed by not going down for the last 2 years, because they're at 20% cash flow and they're valued on cash flow, right? And look, the list, I mean, I'm actually going to try and have Dylan come and do a talk sometime on a webinar, right? It was just a great list of it's the stuff you're grinding out thing after thing. Performance management, rep hiring only when you have the pipe, gating hiring, stuff like that. Where's the saving on remote? It's not really there. Where's the saving on offshore? It's real, but you got to push it. So I could go through it's that kind of, as I said, going back to the macro statement, your cost structure is wrong. This is what you need to be signing up to fix it over 2 years. And if you don't do it over 2 years, the board will push you to do it over 2 months, right, by getting rid of a bunch of people. And those are the only two choices you probably have at this stage. And I find that one of the reasons I push this one is I think this one is the way to preserve your upside. And remember, going back to the CFO dilemma, that's the hard part of the job. And then the last couple of slides are board approval tips. Because in the end, it's funny, I looked at one piece I said on last year's board approval tips. The last point I made in last year's deck is board approval this year is easy. Plans were so easy. Remember plans last year? It was like, yay, I think we should grow at 200%. That feels great. We should do that, right? It's totally different this year. I mean, I've just come from a board discussion. We're all, it's a grind, right? Going back to, let's be honest, part of it is, it's a tough time. Part of it is individual tensions in every venture firm about decisions they've made and now own, right? And I think you've got to link back to the plan. You got to be side by side with your CEO, otherwise you're screwed. At the margin, there's going to be things that you'll need your CEO. If you're leaning into something that's a marginal call, you better be aligned with them. You don't want to push it and then have them say, I'm not sure how I feel about this, right? You need to know, like if the CEO says, the 3 most important things that we've got to preserve in the company this year are A, B, and C, you better be aligned to that, and he better be convinced, and he better have done the work on it. Because otherwise, you're just going to get drift off course. Make it easy for us to understand. This is the stuff I always tell you, right? It's just like, pick the high, you'll do the detail, you'll do the build-up, but start with the summary, then dive into the detail of events, and then go back to the summary. Remember, we know so much less than you guys realize every time. We're so, jumping from deal to deal, ground us in the basics. Don't dive into the detail because we get lost. I just came from a board meeting with MG today, and I thought those 2 summary slides were really good. It's like big animal pictures. This is our base case. Burn, net new ARR, where we'll be at the end of the year. This is what worse looks like, and this is what better looks like. Okay, now I can have a conversation. It's simple enough for even a venture board member to understand, right? And then the last comment is, it will be dominated by the cash need. No matter how hard you try, if you need money this year, you're going to be just stuck on that. And even if you don't need money this year, I always say this, but please give us a multi-year plan, because, I always feel every CFO should answer the question, unless you're at 2 million in run rate revenue and really so on, how much from here to break even, right? You should have some sense of that. Is it a hypothetical plan? Will it probably be wrong? Yes, but it's a starting point, right? The worst thing you can do is leave me with, here's a 23 plan, and at the end of it, we burn $4 million in the last quarter. We have $12 million left in the bank. Guess the ending. Well, I don't want to guess the ending, right? I want to know what 24 looks like, because that will matter, right? It sounds obvious, but the number of times it happens is astonishing. And then the last comment here is the new inevitable annoying question, right? And last year, every single board member asked, are we growing fast enough? Just remember, and I said to you then, you got to be ready to answer. You better have thought of it before, you better have a philosophy, you better have an answer, right? And now literally the same people are asking the exact opposite question. Can we grow at the same speed with 10% less people? And the advice is the same. You better have thought it through, right? And you have to have a philosophy on, what's worth preserving. You have to know how you benchmark with other folks. In that stuff that I had Dylan do, one of the things they did, and he'd be the first to say he was surprised that he had McKinsey do a benchmarking survey, right? It just, and we got our ex-McKinsey guy here, right? It just allows you to say, I know the hard facts and where we are versus other people. Simple stuff like ARR per head count, cost per head count, just can you ground yourself in reality, right? Because if you're getting into discussion, can you do more? Because in the abstract, we all want you to do more with less. Duh. Right? The real question is it realistic, and then facts to do it. And then the last comment I'll make here, and then I'm done, is I said, although it's annoying, that question, it's actually the right question. And I say that in part for myself, because I tend to be much more the let's just grow this company, Frankly, I hate seeing people who probably make 7 figures a year telling people to make 6 figures a year to fire people who don't make even 6 figures, right? It kind of sticks in my throat. So the venture person, the capital allocator whining about burn, it always just annoys me a little. But one thing I learned in dealing with activists is just because they're incredibly annoying doesn't mean they're not right? And maybe in this case, the whiny person in the corner saying we could do it with 10 less people could be right. And I have to overcome my disposition to say, yeah, thank you, shut up. And say, you know, in this case, we could get a little more efficient. This is the year of the efficient weenie, right? And we got to be those efficient weenies or we won't be there. That's it. Thank you.